Imagine being able to enter the U.S. stock market with less money than you might spend on a coffee or a fast food meal. Many people believe investing in America's stock market requires thousands of dollars, insider knowledge, or years of experience. But that belief keeps beginners stuck on the sidelines. The truth is, there are hundreds of U.S.-listed stocks trading under $5. And while they come with higher risk, they also offer a powerful learning opportunity for new investors with limited capital. In this video, we are not chasing overnight riches or viral hype. Instead, we are breaking down how low-priced U.S. stocks actually work, why some companies trade at these levels, and how smart investors approach them with caution and strategy rather than emotion. By the end of this video, you will clearly understand what under $5 stocks really are, what makes them dangerous, what makes some of them interesting, and how beginners can avoid the most common mistakes that wipe out small accounts. Before we go any further, it is important to set the right expectations. Stocks under $5 are often called penny stocks, but not all of them are the same. Some are early-stage companies, some are struggling businesses trying to recover, and others are solid companies that fell out of favor due to temporary problems. This video is designed for educational purposes, especially for beginners who want to learn how the U.S. market works without risking large amounts of money. We will talk about where to find these stocks, how to analyze them properly, and how to manage risk so one bad trade does not destroy your entire portfolio. This is not financial advice, and we will not be telling you to buy or sell any specific stock. The goal is to help you think like a disciplined investor, understand the rules of the game, and make smarter decisions when dealing with low-priced U.S. stocks. Low-priced U.S. stocks, especially those trading under $5, are often misunderstood. Many people assume they are all scams or guaranteed losses, but the reality is more nuanced. These stocks usually fall into three broad groups. First are small or early-stage companies that have not yet grown into higher valuations. Second are turnaround companies that faced financial trouble, bad management, or industry-wide downturns. Third are companies suffering from dilution, where too many shares were issued, pushing the price down even if the business is still operating. Stocks under $5 can be listed on major exchanges like NASDAQ and NYSE, or on OTC markets, which carry much higher risk. The biggest dangers with these stocks are volatility, low trading volume, and sudden price drops caused by bad news or market manipulation. Prices can move fast in both directions, which is why emotions destroy most beginners. Understanding why a stock is cheap is far more important than the price itself. A low price alone never means a stock is a bargain. And ignoring this fact is how most new investors lose money quickly. Finding under $5 U.S. stocks requires structure, not social media tips. The safest way is through stock screeners that allow you to filter by price, market cap, volume, and exchange. Always start by separating exchange-listed stocks from OTC stocks, because OTC stocks lack strict reporting requirements and are far easier to manipulate. Volume matters more than price. A stock trading at $3 with strong daily volume is usually safer than a $1 stock with almost no trading activity. Market capitalization also gives context. A $5 stock with a tiny market cap behaves very differently from a $5 stock backed by real revenue and assets. While searching, you must immediately eliminate red flags such as constant reverse splits, frequent share dilution, no recent financial reports, or exaggerated promotional language. Cheap stocks attract hype, but serious investors focus on data, not excitement. Learning where and how to look is the first skill that separates disciplined investors from gamblers. Analyzing cheap stocks properly is where most people fail. Because the price is low, beginners often skip fundamentals. But fundamentals matter even more here. Start by checking revenue trends. Is the company growing, shrinking, or flat? Next, look at cash flow and cash on hand. Many under $5 stocks fail simply because they run out of money. Debt is another key factor. Too much debt combined with weak revenue is a dangerous combination. After fundamentals, look for real-world catalysts. Earnings reports, regulatory approvals, contracts, or restructuring news can move these stocks significantly. Avoid vague promises and focus on confirmed events. Technical analysis should remain simple. Identify support and resistance levels and pay attention to unusual volume. A sudden spike in volume often signals news or speculation. The goal is not to predict every move, but to understand probabilities and avoid blind trades driven by hope. Certain sectors consistently produce stocks under $5, and understanding this helps set expectations. Biotech stocks are common in this price range because research is expensive and outcomes are uncertain. One failed trial can crush a stock overnight, while one approval can send it soaring. Energy stocks, especially smaller oil and gas companies, also fluctuate heavily based on commodity prices and debt levels. Electric vehicle-related companies, such as suppliers or battery startups, often trade cheaply due to intense competition and cash burn. Retail turnaround stocks appear here when consumer demand weakens or management struggles. These sectors are active, emotional, and headline-driven, which attracts traders but punishes careless investors. The key is not to fall in love with a sector or a story. Cheap stocks in popular industries can still be terrible investments. Sector knowledge helps you understand risk, not eliminate it. Treat these categories as learning environments, not guaranteed opportunities. For investors with small capital, strategy matters more than stock selection. Never put all your money into one cheap stock, no matter how convincing the story sounds. Position sizing protects you when things go wrong, which they often do in this space. Plan your entry carefully and avoid chasing sudden price spikes caused by hype or social media attention. If you miss a move, accept it and move on. Always define your exit before you enter. Know where you will take profit and where you will cut losses. Small losses are part of the process. Large losses destroy accounts. Decide whether you are trading short-term, price movement, or holding for a longer-term thesis. And never mix the two emotionally. Under $5 stocks can teach discipline, patience, and risk control if approached correctly. Used carelessly, they become expensive lessons. Investing in U.S. stocks under $5 is not a shortcut to quick wealth. It is a way to learn the rules of the market, while risking only a small amount of money. These low-priced stocks carry real opportunities, but they also carry real dangers. Price alone does not determine value, and chasing hype without research is the fastest way to lose money. The key takeaways are simple. Understand why a stock is cheap. Analyze fundamentals and catalysts. Manage risk through careful position sizing, and maintain discipline with clear entry and exit rules. By treating these stocks as a learning tool rather than a gamble, beginners can gain valuable experience, develop sound investing habits, and gradually grow confidence in the market. Remember, even experienced investors treat cheap stocks with caution, because small missteps can have big consequences. If you found this guide helpful, consider subscribing to stay updated on practical investing strategies, even with small budgets. Like this video if you want to follow up where we explore real examples and show step-by-step analysis of under $5 US stocks. Share your thoughts in the comments below. Are you planning to start small, or do you prefer safer, higher-priced stocks? The journey into investing starts with understanding, not rushing. Start small, stay disciplined, and over time, even modest investments can teach you the habits that lead to bigger financial success.